The Money Show.
Personal Finance with Warren Ingram.
24 minutes now to 8 at the time. Warren Ingram, of course, is a financial advisor and co-founder at Galileo Capital. Tonight, we're talking about the silent thief that takes your money without you ever realizing. And we're talking about something we talk about all day on The Money Show in so many different ways. We're talking about inflation. Warren, good evening to you. And inflation is actually the whole point of investing. It's why we do it. And what's so, I'm going to use the word insidious about it, is if you're not careful, you won't notice inflation.
It feels to me like a slow poison to the value of your money, because you feel fine today and you feel fine tomorrow and the next day. But over time, suddenly, you wake up one day going, gee, I don't feel so good anymore. And it's the same with your money. What you buy today and what you buy tomorrow is probably not very different. But we all talk about it, that, gee, what we were buying a year ago, we can't get the same value today. And we all have these wonderful theories about why, and why isn't inflation coming down and all of these things. But the reality is it is part of life. And it's going to be part of life for as long as we have a monetary system, and there isn't a better one. So guess what? We've got inflation. And I guess our next point then is we need to figure out how we look after ourselves so that we protect our money and our investments from inflation into the future, rather than always just being surprised by it and having no antidote to the slow poison.
Okay, your questions for Warren about inflation or other issues if you like. 011 88 30702, 021 446 0567, and of course, voice notes for him as well on 072 702 1702. Let's start with a definition, always a good place to start. I was taught in school. How would you define inflation? Lots of different definitions. Some of them are very textbooky, Warren. How do you as a personal finance guru explain it?
Far away from the textbook, if I can help it, Stephen. Otherwise, we'll all fall asleep. So I think maybe the two things to understand. There is a country inflation rate, and that's the number that gets quoted by every economist known to humankind, the CPI, Consumer Price Index. And that's the average of the most average basket of goods that some actually fictitious person would spend their money on. And so no one is perfectly average. And so when I hear people complaining that, the inflation rate was quoted at 4.2%, and actually my cost of living has gone up by 10%, that's the point. Your cost of living is not the inflation rate. You're not the average person, unfortunately. So each of us will have a rate at which the things we buy on a normal day-to-day basis are changing, and changing, unfortunately, usually means going up in price. So, if you drive a car, it's your tank of petrol. If you eat out at restaurants, it's the plate of food you were buying last year. What does it cost this year? And the travel that you do, all of those things. So it's measuring the rate at which those costs that you spend are changing. And it's not some big conspiracy theory that the Reserve Bank's lying to us about the CPI. It's just a different measure. So unfortunately, there isn't really a measure for any of us to measure the rate of change of our own cost of living. I wish the economists would actually do it, but there isn't one. So the best we've got is this average thing called CPI, and the Reserve Bank is trying now to get it to a rate of about 3%. They give themselves a little bit of leeway, somewhere between 2 and 4, but the hope is that they get to 3. That's their target.
Okay, so the Reserve Bank tries to keep inflation between 2 and 4 and a target of 3, but that's not very high. You would hardly notice over a year. Why does it become such a big problem?
Because you used that lovely word, I hope I said correctly, insidious. So, a rate of change can be small from one day to the next, and maybe even from 1 year to the next. But then we have this thing called compounding. And so I just used an example of 5%, which feels to me maybe more reflective of a lot of our own sort of experience around cost of living. And so when you start at your cost of living changing and going up by 5% a year, doesn't seem like much. But just to take it over a longer period of time, if you buy a basket of goods today for $100 and your cost of living is going up by 5% a year, in 10 years' time, you'll need to spend 163 Rand to buy the exact same stuff So you haven't gone and upgraded or anything. You're still buying the same old basket, but now it costs you 163. And in 20 years, it's gone up to 265. So, nearly three times the price. And all you've done is had a cost of living going up against you at 5% a year. So yes, I mean, it doesn't sound like much, and I think that's the problem, is that it doesn't feel like a big move day to day, but it certainly compounds against you, and that's really the problem with compounding, is it's a wonderful thing when it's working for you, and absolutely horrible when it works against you.
So in other words, if you want to stay the same, you need to earn more money every year. If you want to, you're running to stand still.
Exactly right, and 5% is a pretty steep target to kind of grow your money at, and for people who are working, they're trying to grow their income levels at the very least by the cost of living changes for themselves, and then trying to make sure that their investments are going. So you're quite right. I'd say maybe the analogy is you're probably jogging fairly quickly to to stand still. So what you've got to do is make sure your investments can run a bit faster than a jog.
Okay, so then just keeping cash is not going to work for you, and that's really the big lesson, and that's why we invest.
I think it's an important thing to talk about, because we kind of get lured in by interest rates. We look at a nice fixed deposit or something like that, and we say to ourselves, well, the world's really uncertain at the moment, and we've got the Americans and in the Middle East and the Russians in Ukraine, and there's a lot going on, kind of elections everywhere, including South Africa coming up, and so I can just lock in a really nice interest rate at my bank. Let me just do that. And so it is really worth talking about, because I think a lot of people do that. And some people don't trust banks, so they keep their money under the proverbial mattress or in the couch or whatever it is. And just to understand, like when you do that, you are then eroding the value and the buying power of that money. So if you keep it in a bank account and you get a higher rate of interest, you might now feel that everything is good, and I'm not losing every day. My money's going up. But unfortunately, cash rarely, almost never, actually tracks the rate of your cost of living. So the buying power of your money does go backwards, even while you haven't lost a cent.
Okay. Your question for Warren Ingram on inflation, personal finance tonight, 011 883 0702 021 446 0567. And of course, your voice note questions as well on 072 702 1702. 16 minutes now to 8. Warren, the people who save the most, these are savers who take, I suppose, a very low risk, because that's why their investment doesn't grow. And then if you aren't earning a salary that's tied to inflation, but you've retired.
Yeah, those are probably the two big categories. So some people are really good at being disciplined. They spend less than they earn every single month, and they diligently do the big job, the tough job, and then what they do, which is really catastrophic, is that they then allocate the bulk of their money to very low risk investments. But back to our fixed deposit kind of an example, and so they are the ones that really get hurt by a very big change in cost of living, because if their interest that they're earning is not keeping pace with inflation, and maybe just to emphasize, even if you lock in a very nice rate, you manage to get yourself an interest rate of 8% at a bank somehow, understand that you're probably giving away 2 or 3% of that to tax. So you've bought certainty by being low risk and getting a nice fixed deposit, and you've done the job, but what you've forgotten about is tax, and then the cost of living erodes the buying power of your money. So the low risk, diligent saver is really losing out. Then back to the retirees. There are retirees, for example, who would lock in a pension. They would get a life annuity, and if you work for government, you might decide, I'm just going to get a guaranteed pension. And that's okay if your guaranteed pension is escalating at the rate at which your cost of living is escalating. But if your cost of living is going up at 10%, as an example, and you're getting 5% a year increases on your pension, you could be losing a lot of money. And just back to that example, so someone who spends 50,000 Rand a month to live comfortably now as a retiree, let's just say that they're getting that inflation rate of 5%. In about 14 years, they need 100,000 Rand to fund the same lifestyle. And if their escalations are not at 5%, if they're at 3%, let's say that they go to the Reserve Bank's new target, they are not going to be able to live the same lifestyle they were in the past.
Okay, that all sort of makes sense. So, I mean, if you retire on, say, 50,000 Rand a month, it sounds like a nice amount. What happens over time?
I think you've got to be very careful of how you allocate your investment money. So, understanding that you're okay today, what you always want to do as a retiree is make sure that you're not absolutely maximizing the amount of income that you're drawing out of your investment. So, if you've got a reasonable withdrawal rate, you want to leave behind some of the money that's growing in your retirement fund, so that the growth rate that you're getting on your investments is at least matching, ideally actually a little bit faster than the cost of living. And so you start to make the money work a bit harder than what it's compounding against you. And now all of a sudden, back to our jogging analogy, your investments are running and your cost of living is jogging. So now you're starting to get ahead. And every year, as the cost of living goes against you, so your investments are able to protect you from that rate of change.
Okay. Yeah. I mean, that does make sense. There must be particular ways to beat inflation. How do you go about doing that? Because we talk about risk-averse savers being the ones who actually lose out. So then this is really about managing risk.
Yeah. And maybe the starting point is you understand the assets that can actually work harder than inflation. And the biggest one for all of us will be, investing in the stock exchange. So whether you're investing some of your money into the local and some into the global markets, those are the two markets that will give you the best chance of really doing a lot better than inflation over time, and sometimes to kind of double or treble the rate of inflation. So people who value certainty just understand that the stock market is almost the opposite of certainty. It's going to give you an incredible roller coaster ride, and when the news flow is noisy and loud and scary, sometimes it becomes tempting to look for an alternative. But if you are focused on the thing that's actually the worst for your money, which is inflation, then you should start to embrace some of that uncertainty, because that uncertainty is kind of that butterfly in your stomach that you get every now and then when you look at your statements, tells you that hopefully you've got investments that are going to beat inflation over time. So one, I think you've got to bump up your allocation to shares, but both local and global. And then make sure that that emergency fund that we've spoken about on this show a lot, make sure that it is fully funded, so that if something goes wrong at the wrong point in time, that you're not then having to draw money from your stock exchange investments. You can rather draw it from your emergency fund, and that's the money that will keep you safe when things are going wrong. So I think understanding that when you're investing for a 5-year period or longer, the stock exchange, property companies that trade on the local and global markets, and even government bonds are what we would call productive assets. Those are the things that beat inflation over 5, 10, 15-year period. In the short term, they're going to work against you and they're going to be unsettling, but they do protect you over time.
And this is really about a balanced portfolio. You need to manage that. That's really the best place something you really need to look at because of the balance it gives you.
Yeah, I think, for someone listening who goes, gee, I don't actually know how much I've got in shares, and what I've got is a bunch of unit trusts, in my RA and in my company retirement fund and my tax-free and, some other stuff that I own, and I can see it on statements. What you don't want to see there is a bunch of funds called cautious or moderate. You need to see funds that are called balanced or growth. And that will tell you something on its own, which is probably that you've got a decent allocation to the stock market already. And for most of us, having just a very well balanced allocation to a balanced fund is probably the thing that's going to protect the buying power of your money. So it doesn't need to be complex. We're not talking about rocket science stuff here, but just making sure that you get that mix correct now, so that you protect yourself.
All right, we have a question from Nikki for you, Warren. Nikki says, hi, I noticed my investments have not done well since the start of the year. I have a large portion of my money in offshore markets. I'm not sure what to do to protect my investments now. Yeah, Nikki, I mean, you and Elon. We'll have a response for you from Warren in just a moment.
The Money Show. Personal Finance with Warren Ingram.
8 minutes now to 8 the time. Your questions for Warren. Of course, Nikki's asked, I noticed my investments haven't done well since the start of the year. I have a large portion of my money in offshore markets. I'm not sure what to do to protect my investments now. Warren, I don't think Nikki's the only one thinking like this, because I think it's actually quite scary in a way, for so many different reasons.
It is. I'm probably struggling to kind of hide my frustration at the question, to be very honest, Stephen. I think, it's one of those things when, if we were talking, let's say December last year, investments did incredibly well, and global markets had done very well. The JSE had done very well. And, even to the end of, if you go 12 months from now, 12 months from the end of June backwards, investors have done phenomenally well out of the JSE, and in dollar terms, over the last year, they've done very well on global markets. So when things have gone well for a sustained period of time, which is exactly what's happened, then, guess what? It's called a roller coaster for a reason. So when it goes up and up and up and it's going very well, don't get accustomed to that it can only ever go up. It must come down. That's the whole point about markets. If they're guaranteed returns that were only good all the time, no one would be working and everyone would have been retired in La La Land. Unfortunately, we live in the real world, which means markets go up and they go down. So if your portfolio hasn't done well for the last little while, the JSE is down. The average general equity unit trust in South Africa is down for the first 6 months of the year. It's normal, and I think that's the point here. We can kind of say to people, don't worry, everything's fine. That is true, but the danger that people pose is probably themselves to their own investments. In other words, you start to think, well, 15% a year is normal. When I only get 1%, then I should change all my investments and throw out what I've got. No, that's not what you should do. What you should do is let this ride out. This is normal. This is what happens in markets, and don't be fooled by the years when you get 15 or 20%. You need to be realistic and say, well, actually, over long periods of time, if I'm getting 10 or 11, I'm doing incredibly well. And this is the price I pay. The volatility is the price I pay. So number one, don't get impatient. Number two, don't panic. This too shall pass. And so people that kind of judge your investments over 3 or 6 months are just doing themselves a huge disservice and causing me grey hair.
So, the problem, I suppose, is when you have a year like last year on the JSE and it's up 30%, you just get spoiled, isn't it? And isn't that really the issue?
Exactly, and I think that's really the comment. Is I understand that it's not nice to see your investments go down, especially when the news flow is just incredibly rocky, and it just sounds like the world's coming to an end. But it's been like this many times in the past, and we're all still here, and markets do go up. And so, exercise a bit of patience and a bit of restraint, and just have a bit of context. When things haven't done well for 6 months, maybe zoom out a bit and say, what have my investments done over 3 years and 5 years? And that guy on the radio that talks about investing always says long term, and long term starts at 5 years. So what has that done? And if it's done okay over 5 years, then maybe you're okay now, and maybe this is the price we pay, is a little bit of up and down for now.
Okay, so certainty then. I think a lot of people are quite keen on certainty. I suppose we all are. So you avoid shares, you avoid property companies. How then do how do you sort of get the balance right? Because the problem, of course, then is that you need to make sure that your investments have an opportunity to grow. And that means making an investment, not just saving. That's the difference.
It's possibly the most expensive decision you'll ever make, is to lock in certainty, buy a guarantee. In other words, go to the bank and give me a fixed deposit. Give me a capital guarantee on an investment where I'll never lose money. Those two things to give you psychological certainty. It feels great. You feel good today and you feel good tomorrow because you never go down. But what you've done with that certainty is also give yourself the guarantee that your capital will not grow faster than inflation. And that's why we talk about this so much, is we just don't want you to kind of feel the false sense of security of, I'm okay now because my portfolio didn't go down yesterday or last week or last month or even for the first 6 months of the year. And what you're missing out is, yes, and the buying power of your money is getting eroded. And yes, after tax, you're in a way worse position. And in 10 years' time, the person that kind of tolerated the uncertainty is in a way better position than you. Even though they might have had a few sleepless nights, you're in a position where the buying power of your money won't allow you to eat properly anymore. And that's the point here. It becomes a very hard choice when you're much older and late in life, when you can't readjust your investments. So my comment is, embrace a bit of uncertainty and don't go for certainty at all costs, because it's really incredibly expensive.
And then we've got 30 seconds, Warren, but isn't the other lesson that you have to be engaged in your personal finance? You can't just put it somewhere certain and leave it. You have to be actively involved.
Yeah, do a review every 6 months or at the worst, every year, and then be patient when things have gone down for a short period of time. That's not the time to now become an investment expert. That's the time to kind of zoom out and have a look at what everything has done for a period of time and make sure that you're okay.
Warren Ingram, thanks so much. Really appreciate it. The co-founder at Galileo Capital and, of course, a certified financial advisor. And as always, the person you go to for all of your questions about personal finance on The Money Show.